That space between the first candle's high and the third candle's low is what we call the fair value gap. Once you find it, draw a rectangle over that zone on your chart. That's your area of interest. This works both ways in bullish setups. The gap is created as price pushes upward. In bearish setups, the gap appears as price drops rapidly. Just remember, if there's no gap between the first and third candles, there's no valid fair value gap, no matter how large the middle candle is. Let me share 4 practical tips I use to filter out the noise and focus on the best setups. Tip number 1: use only unmitigated gaps. The best fair value gaps are fresh, meaning price hasn't returned to test them yet. Once price comes back and touches the gap, that zone is considered mitigated. Its edge weakens, so if you spot a fair value gap that has already been retested, it's better to skip it also. Watch out for price that retraces too deep. If it closes inside or below the gap, the setup becomes invalid. Ideally, you want price to tap the gap, respect it, and bounce. Tip number 2: size matters. Larger fair value gaps generally offer stronger setups. Why? Because a wider gap indicates a more aggressive imbalance between buyers and sellers, which makes it more likely that price will revisit and react from that zone. When you have multiple fair value gaps on the same chart, prioritize the bigger ones. Tip number 3: watch out for fair value gaps near major levels. Here's a common trap. You spot a beautiful fair value gap, but it forms right underneath a major resistance level. That's a red flag. Why? Because price may reach that resistance, reject hard, and invalidate your fair value gap. It's always smart to check your surroundings. Avoid fair value gaps that appear too close to obvious barriers like support and resistance. Tip number 4: focus on fair value gaps that form right after a break of structure. Some of the most reliable fair value gaps form right after a break of structure. When price breaks a key level and immediately leaves behind a fair value gap, that zone becomes a high probability area for smart money to re-enter. The first retest of this fair value gap often triggers a strong reaction. Now let's move on to another powerful ICT concept: the power of 3. The power of 3 is a smart money trading pattern that segments price action into 3 key phases: consolidation, manipulation, and acceleration. Let's start with the first phase: consolidation. During the consolidation phase, smart money begins quietly building positions while price moves sideways within a tight range. To the average trader, the market looks indecisive or stagnant, but in reality this phase is critical. It lays the foundation for the next major move. This is the first stage in what's often referred to as the power of 3. Next comes the manipulation phase, where the market fakes a breakout to the downside or upside. This move is designed to trap retail traders by triggering stop losses and luring in breakout traders. It's a classic liquidity sweep, engineered to collect orders from unsuspecting participants. A liquidity sweep typically occurs when price dips below a clear support level and then snaps back into the range. This false breakout isn't a true shifting trend. It's a smart money tactic to gather liquidity before the real move begins. Once enough liquidity has been captured, smart money drives price rapidly in the opposite direction. This sharp move is known as the acceleration phase. This final phase is where momentum kicks in, and this is your opportunity to enter after the trap. With the institutions catch this acceleration, and you're no longer chasing the move. You're riding it. That was the bullish version of the power of 3. Now let's break down the bearish version. This one plays out at the end of an uptrend, a setup for downside momentum. Here's how it unfolds. Beginning with the first phase distribution. Price consolidates, forming a tight range. But behind the scenes, smart money is offloading their long positions, selling into strength while retail buyers pile in. Next comes the manipulation phase. Price suddenly breaks above the range, triggering breakout entries and stop losses from short sellers. Retail thinks it's a continuation, but it's not, it's another trap. Price quickly returns inside the range, revealing the move for what it was, a liquidity sweep. Finally, we enter the markdown phase. Smart money has exited, liquidity has been swept, and there's nothing left but empty space below. This is your moment to catch the trend from the very top, riding the momentum smart money just created. Now, let's talk about how to actually trade the power of 3. Both bullish and bearish setups. Once you know how to spot it, the next step is timing your entry, managing your risk and targeting your exit like a pro. When the market is in an uptrend, smart money will eventually begin taking profits. Here's what to look for first. Wait for distribution. Price starts to range. After a strong move up, this is where smart money starts offloading positions. Then comes manipulation. Price breaks above resistance, triggering breakout buys and stop losses from sellers. Watch closely if price closes back inside the range. After that breakout, that's your signal. It's a liquidity sweep, not a true breakout. Your entry is on the close of the candle that returns inside the range. Place your stop loss just above the high of the breakout candle. Your target the next major support level. This setup lets you ride the mark down, the acceleration phase to the downside, after smart money has trapped retail traders. When the market is trending down, smart money eventually looks for a place to start buying. Here's how to spot the reversal. Watch for the accumulation phase. Price begins to range after a strong downtrend. Then comes the liquidity grab. Price drops below support, triggering sell stops and drawing in breakout sellers. If the next candle closes back inside the range, that's your entry signal. The trap has been set. Smart money is loading up. Enter at the close of that candle.